All right, and we are live again. So I was not actually planning a live stream show tonight. I was going to do a short video with a lot of the crisis indicators. The slide deck is done. Maybe I will work on that in a couple hours later. But what is happening in the oil market, it merits a live stream show. And for those of you who do not want to be a Patreon account contributor, tonight is your lucky night. You are going to get pretty much everything for free. Stuff that the Patreon account contributors get at a good value of $5 per month, you will get tonight for free as a public service announcement warning due to my experience in the oil market, my contacts, and how I've been warning people for over 8 months that there was going to be a pretty bad bear market in the oil market, and things are even worse than I expected. So there is a complete and total bloodbath in the oil futures market right now. If you go for free to tradingview.com, that is tradingview.com, you can take a look at the oil futures market. We are down over 20% on oil futures contracts, and the oil futures market has only been open for about 2 hours tonight so far. So it got as low as $30, and right now the oil futures market for light crude oil futures is down to $32.67. The oil price has already dropped over $10 per barrel. An absolute, complete, and total bloodbath. A falling knife. There is no other way of sugarcoating this. This is complete and total disaster scenario for the oil market. This is why you have PetroChina and other large Chinese state-run, state-owned enterprise oil companies that are dumping oil like crazy over the last month or so. There's been a lot of stories out about this, talking with oil traders, like my contacts, like Shy Girl, who I've been speaking to. The story that came out in the last week or so about Chinese oil companies dumping oil onto the market, it had been going on for weeks, from what I've been hearing. And you have force majeure now with natural gas contracts in China. That is how much demand for natural gas, as well as oil, has collapsed in China. The real truth about the recovery in China, it's not there. So there is some recovery, but it's nowhere near the levels that the Chinese government is pretending. So demand for oil and natural gas in China has totally collapsed, and this is the absolute worst case scenario for oil producing companies. Hopefully some of them hedged at the first week of January, when I think WTI oil prices were around $63 a barrel. The first week of January, when we had General Soleimani taken out by President Trump in Iraq. But since then, the oil market is down 30% in barely 3 months. A 30% catastrophic drop. The oil industry cannot handle this. Let me give you some examples. Again, normally this would be behind the paywall for my Patreon account contributors at $5 a month. My well over 400 now, growing quite a few per day, should be 500 hopefully in the near future, Patreon account contributors. Let me give you some examples of how horrific things are in the oil market. So, Diamond Offshore, symbol DO, Derek Oscar. Normally, Diamond Offshore, and I've been an oil analyst in the past for my day job. I worked under Robert Rapier, one of the best. He has a $500 per year oil and investment newsletter. He's worked in the oil industry, different jobs at ConocoPhillips and others for 30 years now. Also writing an oil investment newsletter too, besides working in the oil industry full time. Normally, Diamond Offshore is a very conservative deepwater offshore drilling company. However, the deepwater offshore oil industry is getting killed so bad, and this is despite the day rate that these deepwater offshore drilling companies charge to lease the rigs, despite the day rate increasing 75% in a year in 2019, which was one of the largest rallies in a long time, in years, like 4 or 5 years. Despite that, the SEC filings, and I was looking at those over the weekends, over this weekend for Diamond Offshore, the SEC filings from February for Diamond Offshore were absolutely brutal. The stuff in there that was disclosed basically predicting bankruptcy in the near future. Okay, they now have negative cash flow. They are cash flow negative. So even before oil prices collapsed at the current levels, even before the day rates collapsed, as far as I know, the day rates have not collapsed yet. As far as I know, they have not lost any contracts yet even before all this, in the first week, 10 days of February, Diamond Offshore Drilling was cash flow negative. They were warning that they were going to have to go onto the credit cards, which for a large corporation is your revolving credit facility. If you use a revolving credit facility smartly, you can add more cash flow to your company quickly, and then you pay it back. That is how you are supposed to use a revolving credit facility. That is not how Diamond Offshore disclosed in February how they plan to use their revolving credit facility. They basically said that they are going to run out of working capital in the near future if oil prices do not turn around, and that they are going to delay bankruptcy as long as they can by maxing out their credit cards, their two large revolving credit facilities. So this is the most conservative out of the bunch for the deepwater offshore drilling companies. Diamond Offshore, very well respected. Over the years, when I've looked at the company and their financial statements, they were very careful with not paying out too much dividends. They were very careful about over-leveraging their balance sheet. They were very careful about acquisitions. And in spite of all this, Diamond Offshore not looking good. Could be a year, could be less. It depends on oil prices. So you have a situation now with oil prices falling, this falling knife. On top of this, the story came out on Friday, March 8th. Well, actually, wait, this is updated. So this came out a couple days ago. This Bloomberg article is updated. I think it came out a day or two ago. Saudis plan big oil output hike, beginning all-out price war. So OPEC and the Saudis and Russia, they had initially planned early last week, to do a 1.5 million per day barrel production cut for oil production. 1.5 million barrels per day is a lot. In the past, when there was this much of an oil production cut, it would normally mean a very, very big jump in oil prices pretty darn quickly. Less than 48 hours, maybe even less than 24 hours. Sometimes within a couple hours, you would have a big pop in the oil price. And guess what? That did not happen. In fact, oil prices continued to slide. And in my opinion, that is because the demand for oil right now, especially out of China, also in Europe, where people are not allowed to go to, football matches. Here in the U.S., we call it soccer. In Europe, it's football. Or Latin America, it's football matches. Not allowed to go. They're not allowing fans in. They're not allowing fans to go to hockey games in Europe. So that is less driving. Less goods are moving. Less air travel. Demand has collapsed for gasoline, for jet fuel, oil usage, especially in China, but in many other countries as well. I don't have the exact data on how much demand has collapsed, but it has collapsed a lot out of China. It was more than 20% collapse out of China. Absolutely enormous. So, you have a situation now where Saudi Arabia and Russia, with recent policy announcements, are now going for the absolute knockout blow on shale oil, on the higher cost oil producers. So your deep water offshore drilling, it's not going to be economic at $30 a barrel. Oh, companies are going to claim they can cut costs, but it's not going to be economic at $30 a barrel. There are very few deepwater offshore companies that can even make profits at $50 and $55 a barrel. Okay, very few, if any. So, and then the shale oil producers, their costs, they're claiming, Peter Zeihan and other people are claiming that these shale producers can make profits at $35 a barrel. It is completely and totally inaccurate. So there was a Dallas Federal Reserve survey. I covered this on my YouTube channel in the last couple months, where the CEOs of these U.S. shale oil producers were allowed to anonymously admit their real costs to the Dallas Federal Reserve Bank. And in the survey, they disclosed that about half of all shale oil production breaks even only at $50 a barrel, and an even larger percentage needs $55 a barrel or higher. So, if they did not hedge their oil costs, their oil production, the first week of January at $63 a barrel, which by the way, a good amount of the industry probably did. There was articles coming out that I covered, and I was saying this was a smart move by the companies that increased their oil price hedges at $63 a barrel first week of January. The problem with this, and we saw this in 2013 when the Saudis tried to kill shale oil then, and they did not But OPEC did not cut oil production then, and they're hoping to bankrupt shale oil companies when the industry production cost for shale oil was at $65 a barrel. Most of the people in the industry agreed on that. But shale oil companies back then were able to cut costs. They were able to raise more capital. So yes, there were bankruptcies, but nowhere near the amount of widespread bankruptcies that many people, including the Saudis, expected. The same situation is not the same factors that happened back then in 2013, 14, and 15 when the Saudis tried to kill shale then are not the same factors now. There is nowhere near the amount of dumb money, pension fund capital available for shale oil companies to go and raise junk bond debt, to go and sell equity to, for the private equity sharks to fleece retail investors, SEC accredited investors or pension funds, and make quick profits with the commissions. There is not that capital available for the shale companies. So you have a situation now where the Saudis, after seeing that the production cuts announcement did not work, did not get the oil price higher, the Saudis have reversed course. So back to the article here. Article is from Javier Blas and Anthony DePaula. Saudi Arabia plans to boost oil output next month to well above 100 million barrels a day as the kingdom responds aggressively to the collapse of the OPEC Plus alliance with Russia. The world's largest oil exporter engaged in an all-out price war on Saturday by slashing pricing for its crude by the most in more than 30 years. State energy giant Saudi Aramco, who, by the way, Saudi Aramco's shares fell below their IPO price for the first time ever. That story just came out in the last couple hours. State energy giant Saudi Aramco is offering unprecedented discounts in Asia, Europe, and the US to entice refiners to use Saudi crude. At the same time, Saudi Arabia has privately told some market participants it could raise production much higher if needed, even going to a record 12 million barrels a day, according to people familiar with the conversations. Asked not to be named to protect commercial relations. With demand ravaged by the cerveza problem, even if I don't mention it because it might be in the title there, this video will probably be demonetized. Opening the taps would throw the oil market into chaos. Quote, Saudi Arabia is now really going into a full price war, said Iman Nasseri, managing director for the Middle East at oil consultant FGE. The Saudi Energy Ministry didn't respond to a request for comment. Aramco's unprecedented pricing move came just hours after the talks between the Organization of Petroleum Exporting Countries, or OPEC, which is a cartel, and the oil market actually has price discovery unlike so many other markets, and its allies ended in dramatic failure. The breakup of, I added those parts, the breakup of the alliance effectively ends the cooperation between Saudi Arabia and Russia. Actually, in different ways, they are executing their own plans to collapse U.S. shale oil and the higher cost oil producers in other countries, like deepwater. Saudi Arabia and Russia that has underpinned oil prices since 2016. Production limits agreed to by OPEC and its erstwhile partners expire at the end of the month, opening the way for producers to ramp up output. And if you're familiar with my YouTube channel or the oil market, I have repeated this a lot, that it is counterintuitive for how things work with national oil companies or OPEC countries. What normally happens when the oil price collapses is you would think rationally when the oil price collapses that oil producers would cut production. They would not produce oil at a loss. But this is not historically what OPEC has done. Normally, OPEC countries actually maintain or increase production when oil prices fall. They hope to make it up on volume because so much of the country's budget, government budget, and so much of the social program spending is dependent on oil revenues. So normally national oil companies, OPEC countries, actually maintain or increase oil production. I know it's counterintuitive, but OPEC is a cartel, and these are government bureaucrats in a lot of cases running these oil companies. So they do not cut oil production. The shale companies are price insensitive too. They're not instituting proper free market behavior either because they have been addicted to cheap debt and cheap capital and sucker pension fund money. So the shale oil companies will have to adhere to market forces at some point. There is going to be, if you think things are bad now, wait until some of those hedges come offline if oil prices are still low. An absolute and total bloodbath. Okay, let me read the Russia article here. Putin dumps MBS, so Mohammed bin Salman, to start a war on America's shale oil industry. From March 7th on Bloomberg by Ilya Arkhipov, Will Kennedy, Olga Tanas, and Grant Smith, 4 journalists in the same article. So Russia's energy minister walked into OPEC's headquarters in central Vienna, knowing his boss was ready to turn the global oil market upside down. Alexander Novak told his Saudi Arabian counterpart, Prince Abdulaziz bin Salman, that Russia was unwilling to cut oil production further. The Kremlin had decided that propping up prices as the cerveza problem ravaged energy demand would be a gift to the U.S. shale industry. The frackers had added millions of barrels of oil to the global market while Russian companies kept wells idle. Now it was time to squeeze the Americans. After 5 hours of polite but fruitless negotiation, in which Russia clearly laid out its strategy, the talks broke down. Oil prices fell more than 10% on Friday. It wasn't just traders who were caught out. Ministers were so shocked they didn't know what to say, according to a person in the room. The gathering suddenly had the atmosphere of a wake, said another. For over 3 years, President Vladimir Putin had kept Russia inside the OPEC Plus coalition, allying with Saudi Arabia and the other members of the Organization of Petroleum Exporting Countries, or OPEC, to curb oil production and support prices. On top of helping Russia's treasury, energy exports are the largest source of state revenue. The alliance brought foreign policy gains, creating a bond with Saudi Arabia's new leader, Crown Prince Mohammed bin Salman. But the OPEC Plus deal also aided America's shale industry, and Russia was increasingly angry with the Trump administration's willingness to employ energy as a political and economic tool. It was especially irked by the U.S.'s use of sanctions to prevent the completion of a pipeline linking Serbia's gas fields with Germany, known as Nord Stream 2. The White House has also targeted the Venezuelan business of Russia's state oil producer Rosneft. Quote, the Kremlin has decided to sacrifice OPEC Plus to stop U.S. shale producers and punish the U.S. for messing with Nord Stream 2, said Alexander Dinkin, president of Institute of World Economy and International Relations in Moscow, a state-run think tank. Quote, of course, to upset Saudi Arabia could be a risky thing, but this is Russia's strategy at the moment, flexible geometry of interest. So, they did initially set up Saudi Arabia, but now Saudi Arabia is piling on. Saudi Arabia has done a 180, and now Saudi Arabia is going to increase oil production too. They said, oh, that's a pretty good idea, Russia. We're going to do our own little strategy here, similar to yours, and we're going to knock out shale oil companies right now. We're going to do it in the next, 6 months, maybe less, at most maybe 12 months if oil prices keep dropping, because the capital is not there anymore. For the shale oil companies, they do not have free cash flow. They cannot afford their capex bills to maintain drilling. So you have Russia and Saudi Arabia now both implementing strategies to increase oil production, or at least not cut, and that's with collapsing demand, with the global supply chain, with the cerveza problems all over the world, especially in China, which I think are still much worse than being reported. There was a whistleblower article from Caixin Global that came out over the weekend. A lot of people are talking about it, citing a bunch of different sources in there. Okay, so now for the really interesting parts here. I'm going to get a lot of emails. Already got a lot of Patreon account contributors messaging me about oil juniors that they have. Already got a lot of emails from people asking me about oil stocks. Here's the part for the pay. Normally I give to the people or Patreon account paid contributors that you are going to get tonight for free. And this is a big warning. So when you have commodity prices dropping this much, a profitable company like ExxonMobil or Chevron or Royal Dutch Shell, this is the thing you have to watch out for. So how much will earnings drop? How much will free cash flow drop? How much will commodity prices drop? Because right now, ExxonMobil, in my opinion, is a yield trap and a dividend trap. And let me explain what I mean by that. So ExxonMobil on a stock chart, ExxonMobil is falling a lot. I believe the stock price is now even below, let me pull up the chart. I believe it's now even below the 2008 levels. Pull it up real quick. Yeah, we're way below 2008 levels. Okay, when oil crashed in 2008 and 9, ExxonMobil got to as low as I think $58.78 a share. We are now at $47.69 a share. ExxonMobil still has $2.84 per share in forward earnings. Its PE ratio, forward PE price to earnings ratio, looks reasonable. And its dividend yield looks very attractive at 7.3% dividend yield. However, and here's the red flag, they don't teach this a lot to retail investors. You have to go into earning. I'm on Seeking Alpha here. You click the earnings tab, you click the dividend tab, and you look at the dividend payout ratio. This is the warning sign here. Dividend payout ratio for ExxonMobil is 122.56% right now. So as of right now, ExxonMobil would be paying out more in dividends per share than earnings per share. So the question is this sustainable, and for how long? So if oil prices keep going lower, or ExxonMobil has to maybe write some things off, maybe their XTO acquisition that they overpaid $30 billion for, or other problems like that, is ExxonMobil going to be able to maintain their dividend in a low or falling oil price environment in this bad a bear market? That is the question. Because if ExxonMobil cuts their dividend, the share price could collapse even more. Let's say their dividend payout ratio goes up to 100. This is hypothetical. Let's say ExxonMobil's dividend payout ratio goes to 140% or 150%. Let's say it goes lower and they don't announce a dividend cut. Let's say the oil prices go lower. So in the short term, they could maybe maintain that dividend. But if the market conditions continue to get worse, the bear market continues to get worse, they will probably have to cut that dividend because the dividend payout ratio is too high. For comparison's sake, let me talk about the dividend payout ratios for Chevron. Right now, Chevron has a more reasonable dividend payout ratio of 80.88%. Not horrible. Royal Dutch Shell's dividend payout ratio is 75.13%. Not horrible. You need to watch these things. If you buy these shares now, and I'm going to issue another warning. Again, not financial advice, just my opinion. But do not buy all of your oil shares. If you're going to dip a toe in here, do not. I'm going to get 10-page emails from people who actually did do this, despite me issuing enormous warnings not to do it. But do not buy all of your oil positions all at once. Again, big no-no. Professional investors don't do this. It is mostly only retail investors who see something like this, like, oh, I'm going to get a 7% Exxon Mobil dividend, and I'm going to get rich a couple years from now. Okay? And then I'm going to get a 10-page email, even though I warned you, for free, because the video is going to get demonetized, to not buy all of your ExxonMobil position at once. If you buy any shares of any of these oil companies, and I don't think ExxonMobil is going to go bankrupt. I don't think Chevron is going to go bankrupt. I don't think Royal Dutch Shell is going to go bankrupt. However, that doesn't mean the stocks won't go lower. That doesn't mean there won't be write-downs. And that doesn't mean that there won't be dividend cuts. Oh yes, definitely hit the like button, please. Definitely please hit the like button. Got a lot of views over here. I think my buddy George Gammon, who's joining this live stream chat now, I think his show's over. I wanted to start this a little sooner. If you miss any of it, definitely go back and listen to the replay. Okay, big warning. Do not buy all of if you're a retail investor, you're not a professional investor, you're not sophisticated, do not buy all of your oil position shares at once. If you want to dip a toe in, do not. Because if you buy all of your ExxonMobil shares now, first of all, on the chart there, it doesn't look like there's good support levels on the ExxonMobil chart. The oil price could fall farther. We don't know when China's going to stabilize. Okay, the evidence is that things with the cerveza problem in Europe and the US are going to get worse. That means less jet fuel used. That means less gasoline used, okay? So, I would say as of right now, ExxonMobil is a yield trap. Because if that dividend payout ratio goes higher, the odds of them cutting that dividend will increase. And a dividend cut for a large stock like ExxonMobil, that could be another 20% drop in share price pretty quick. I've seen in the past where large companies announce either they suspended the dividend or they cut the dividend, and within 2 or 3 days the share price is down at least 20% in a day or two, and then another 40% by the end of the week. Oh, I've been warning people about oil bear market crashing for over 8 months. I was getting really nasty messages below videos, my oil videos, warning people over 8 months ago from people in Texas and Oklahoma working in the oil industry who did not want to hear any bad news, and from oil company executives who listened to this podcast, that I didn't know what I was talking about. That oil demand projections were supposed to increase. Goldman Sachs is even saying oil could get into the low to mid 20s. If it goes, oh man, I don't even want to think about that. That's how bad that is. Okay, so let me just talk about what I want to actually see Chevron, ExxonMobil, and Royal Dutch Shell do. This is if these companies were actually prudently managed. Okay, so what they should be planning on doing, I don't think we'll see this done because honestly, corporate America, especially a lot of large cap oil companies, are so poorly run. There's been financial engineering at ExxonMobil longer than almost any other large company other than General Electric. What I would love to see these companies do, and Chevron is the most conservatively run out of all the large cap companies, large cap oil companies. Chevron and Royal Dutch Shell right now have too much natural gas exposure. So they have less of an oil mix. They do not have a lot of oil production growth and oil reserve growth right now to talk about. What I would love to see is for these companies, with a lot of these other oil companies like mid-tier independents or other good juniors that are collapsing or going bankrupt, I would like to see Chevron and Royal Dutch Shell go and buy some of these assets for pennies on the dollar. That would be smart long term. Now, in the short term, their stocks may get penalized, but in the long term, this would be very, very smart. I don't think we'll see it, though, because of how short-sighted, how myopic so many of these large companies are. Although they have made a lot of smarter long-term natural gas investments, but a lot of these large cap oil super major companies, they have not been making as many good investments into long-term oil growth for production and reserves. They've been focusing way too much on natural gas. Dave says, are we going to see wars? If a lot of people are infected, how are we going to fight a war? Bringing a mass gathering of people together with a pandemic, a global pandemic, probably not a good idea. That's just my water. Okay, I think I covered pretty much everything. I will take a look at listener questions and comments. I think I saw some super chats in there. I wanted to get all the points across. There is a lot of articles I have here if you want to go more in depth on this. They will be in the information and description section later below the video. A lot of people don't check any of the information and description section below the video. People ask for my Patreon account link. It is below every single video in the information and description section. If we do see a war, that would be another large mass gathering of infected people. Do you think that's a good idea? I mean, I don't think the Chinese government cares, but I think these other governments, I don't think that there's the political support to start a war with a lot of human beings. Gundam asks, is Russia going to war with Saudi Arabia? No. No, the media wants to spin it that way. The truth is they're both using different strategies to collapse the U.S. shale oil industry and different higher cost producers like deepwater. What is going on here? Okay, let me see if I can find the super chats here. There was quite a bit of them. Muddy River Dog says Trump wants to blow the debt bubble bigger to get reelected and cheaper interest on his loans. He doesn't give a damn about you. Also, apparently, Trump is grossly mishandling the global pandemic problem so badly. My buddy Christopher Irons at QTR Podcast, another great podcast, he thinks that this will be Trump's Herbert Hoover moment and that Trump will not get reelected. I don't know about that, but we'll see. I suspect the next couple months in the U.S. will be really bad. So not only are many thousands, if this continues with the oil price, not only are many thousands of people in Texas and Oklahoma going to be losing their jobs, there was a record amount of bankruptcies, according to the Houston Business Journal in January 2020, and almost all of them were energy related. So this was before the oil price collapsed. This was just when the oil price was starting to fall more. So be very, very careful. Not financial advice, just my opinion. Be very, very careful if you buy any oil stocks. If you buy ExxonMobil here, do not, again, all capital letters. You've been warned. Do not buy all of your oil position at once. I'm going to get emails anyway. I'm going to get Patreon messages. I'm going to get emails. I'm going to get a 10-page email from someone saying, Jason, I bought $30,000 worth of, hypothetical, I bought $30,000 worth of ExxonMobil stock right now, expecting that 7% dividend yield, and they cut the dividend and the share price fell anyway. What should I do? And I was like, did you listen to any of my podcasts? And the person will say, yes, I listened. I was like, did you listen to the part where I warned you to not buy all of your oil stocks at once? And the person will then reply, well, I heard that, but I didn't listen. Or I heard that, but I wasn't paying attention. You know how many times I've heard that from people in emails or in messages? If I had $1 for every time I've heard that, I think I'd have about 20 grand in cash right now extra to go and buy better stocks than ExxonMobil. So you have to watch the dividend payout ratio. You have to watch for dividend cuts. If you are going to try to catch any of these falling knives, you have to pay attention. You have to watch to see if any of these dividends are cut. If Chevron's dividend payout ratio goes over 100%, and I think Chevron has the best and safest balance sheet of any of the large super major oil companies, they could cut their dividend too. It really depends on how much lower oil prices go and how long they stay there. But a lot of the unexpected event here in the oil market is the demand collapse out of China and how bad the global pandemic is. And if you're saying that the flu is still worse than the global pandemic we have now, you inherently believe all of China's data, which is all a lie. Pablo asked what I think about gold miners. Pablo, there are audio podcasts behind my Patreon paywall addressing this. Multiple podcasts in the last week or two. Charlie asked, why not buy all oil stocks at once, diversify over time? If you buy all of your oil stocks now at once, you're trying to time the market perfectly. You're also catching a falling knife. Because if Saudi Arabia does increase oil production, and Russia maybe increases oil production too, or at least doesn't cut, you are looking at potentially, Goldman Sachs may be right. I mean, for a very brief period of time, we may go into the mid to low 20s. If we, oh my God, that would be so bad. It would be good for people at the gasoline pump outside of California. I'm not even sure if people in California are going to get a discount on their gasoline pump. That's how bad the state of California is. Captain Wacko says, Jason and George Gammon rule. They just need to learn more about Bitcoin. I already know a lot about Bitcoin, Captain Wacko. I was covering Bitcoin actually for years, longer than a lot of other people. I'm friends with Trace Meyer. I've known him for a long time, before he actually bought any Bitcoins. When he was just a lawyer and writing Run to Gold, and his book, The Great Credit Contraction, before he ever bought any Bitcoins. So there's a ton of interviews with Trace Meyer every couple months in the archives of my YouTube channel. I just don't cover Bitcoin that much because I get a lot of hate mail. I get emails from people in the gold community, experts you would know, telling me not to talk about Bitcoin. Bill Holter has said, don't talk about Bitcoin, all this other stuff. He wrote a hit piece on me calling me a Bitcoin pumper. Even though I can't even remember the last time I did a Bitcoin show, I think it's been a couple years. The people in the gold community turn on anyone who recommends Bitcoin. It's pretty messed up. It's similar to what Peter Schiff does on his Twitter, but it's more discreet. It's normally like a long email that's like 3 or 4 paragraphs, bunch of other bullshit. Okay, I think that's... Well, let me look for the super chats. I thought I saw... Okay, here. You're up. Primal American says he's up 5% right now on the DOG. Offhand, I do not remember what DOG was at a short oil ETF. Oh, short Dow. Okay. Scott says he was unsubscribed from this channel. Yeah, I've heard that before. That's why my channel only added 100 new subscribers in the last 6 weeks. People are being unsubscribed without them knowing from my channel. It's really messed up. Manuel throws a super chat for $1.99. Thank you, Manuel. Top oil stocks to invest in. Manuel, first of all, in my opinion, I would not invest in any oil stocks right now. But if you have to, I would maybe think about a little bit. I would not buy all my position at once. Again, I do not want to get emails saying that you bought all of your oil position at once, trying to perfectly time the market, and then you're down, the oil price kept going lower, you ignored my warnings. I don't want to hear that. Do not buy all of your oil positions at once if you want to stick a toe in. People are going to do it anyway, and I'm going to get emails, but if you send me an email, I may embarrass you publicly. I might not use your name, may use a different name, but I may read your email on a podcast to embarrass you. So think twice about sending me a 10-page email and asking me for free to help you for free for a long list of oil stocks that I told you that, in my opinion, you should not be buying, and you bought them all at once and lost a lot of money. Chevron for now. I think Chevron for now is safe. I would like to see Chevron do an acquisition. A low-cost shale oil producer is EOG Resources, but if oil prices keep going lower, EOG is going to be losing money too, unless they hedged a lot of their oil production. Again, I would not want to be long really any oil stocks right now. Okay, historically in the past, Manuel, normally oil refiners in the past, when oil prices are falling, refiners do very, very well with lower input costs. So there was a big I talked about this exclusively on like about almost a 20-minute audio podcast for Patreon account contributors 3 weeks ago when I warned them that oil prices were going to crash more. Yes, I did an audio podcast just for Patreon account contributors about 3 weeks ago telling them that oil prices were going to crash even more. And I don't think a lot of people listened. Anyway, the refining companies are Valero, VLO, Phillips, 66, so like PlayStation, PS, X, like Xavier, and then the other refining company I think is Holly Energy. So normally when oil prices are falling in the past, the refiners that make money make even more money and their margins get better. Now this might change, but in the past, from past bear markets in oil, refiners did very, very well. Again, I'm working on getting oil expert guests on. I had an interview with Tracy Schuchart. If you're a Real Vision TV subscriber or you follow her on Twitter under Shy Girl, she is one of the best oil researchers. So if you do not have a Real Vision TV subscription or you're not a Macro Voices listener, you can follow her on Twitter at Shy Girl, like Chicago, CHI Girl. She live tweets. Her research is unbelievable for the oil market, and that's because she professionally trades the oil market, and I think she manages customer money for oil. She has an oil fund, I think. I have not seen any evidence yet that I've not seen any articles that oil production in Iran has collapsed, but I would not be surprised if I do soon. But if demand is still collapsing for oil, that will not help the oil market that much, in my opinion. Thank you for the other super chat, Primal American. George Gammon is here. George says, thanks for coming over to Jason's live stream. He really knows the fundamentals well. That's a lot of hard work on my part. Pretty much every single day, hours a day for 10 years. I think it's over 10 years now. It's at least 10 years. And I did learn from one of the best oil analysts out there, Robert Rapier. Rapier. You can read his articles for free on Forbes. He does occasionally write some good free articles. But he also writes extensive research on oil companies behind for his paid investment newsletter. Yep, Manuel, you might want to look at the companies like ExxonMobil and Chevron. How much of their oil production have they hedged? So to delve more into ExxonMobil, these large super majors like ExxonMobil and Chevron, they have a large segment of their business that are refining. So their refining industry margins will be very good now, and they will make money refining. However, they will be losing money now on their oil and natural gas, especially if you have PetroChina and other large Chinese companies canceling natural gas contracts. So parts of Chevron and ExxonMobil's business will be doing well with falling oil prices, but you have to go in there and look at which companies have hedged how much of their oil production at higher oil prices and how long are those hedges on for. The problem with a lot of oil companies, and this happened when the Saudis were trying to kill shale oil in 2013, 14, for a couple years, 13, 14, 15, and maybe part of 16. The Saudis tried for a while. The Saudis burned through a lot of their foreign exchange reserves to do so, and the hedges ran off. So they ran out of hedges for some of these oil production companies, and then the oil production was much lower than what they had hedged, and then their balance sheets were over leveraged. And things are even worse now because they can't raise the capital. The oil industry is not able to raise the capital. So what I would like to see is ExxonMobil, Chevron, Royal Dutch Shell go and buy those quality oil assets for pennies on the dollar. I don't know if we'll see that type of long-term thinking, though. Corporate America here in the U.S. for publicly traded companies, they don't do that type of long-term thinking overall anymore. Okay, George Gammon, thank you very much for the super chat. George asked, Jason, how do you think the $25 a barrel oil could affect the junk bond market? I think at that point, I think the Fed has to do bailouts. From what I've heard, that's about 25-30% of the junk bond market. So I think it's over $1 trillion. I think the junk bond market's over $4 trillion now, and I think that's about 25%. It's over $1 trillion now in junk bonds for shale oil, and the defaults were just starting over the last 12 months. I think at some point, I think the Federal Reserve will have to buy them, maybe all of them. Again, I've been talking about this for the last couple of years. The U.S. economy has benefited heavily from having artificially cheap and uneconomic subsidized shale oil compared to the rest of the other countries. If you have a mass default, a very large wave of defaults on junk bonds in a short amount of time, there's going to be hedge funds that blow up. There's going to be pension funds holding the bag that couldn't dump them all. There could be investment banks caught with some of this garbage. And then, of course, the Fed's going to create more dollars out of thin air and pay 100 cents on the dollar to buy them. And this is a good educated guess on my part because the Fed has done this in every collapse bear market cycle. The Fed goes in there and any toxic garbage that's really worth less than 10 cents on the dollar, the Fed overpays and pays 100 cents on the dollar for. If they halt stock market trading for too long, the U.S. Treasury doesn't get capital gains tax revenues. So I'm not sure that's a good idea. So thank you for your question, George. That was a good question. This is a good question by Nathan. Do I think Chevron retirees will lose their pensions? No, I don't think. Well, I don't know specifically. I haven't looked at it. I don't know what Chevron's retirement plan is invested in. So, like with General Electric, they moved a lot of the General Electric employees' retirement plan into General Electric stock, which was very risky and stupid. And then they started taking away that pension plan too. So I don't know if Chevron's doing that. I haven't looked at Chevron's retirement plan specifically, so I can't comment on that too much. Bank Runner asks, who needs tax revenue when you can print it? Well, if the Fed prints too much too quickly, then the dollar will fall even faster. Then it can't be a managed decline. So they don't want to have to print an extra 2 or 3 trillion quickly, and a lot of people notice. That's why they want tax revenue coming in. Okay, well, I think that's it for this live stream show. Again, I've given a lot away for free here. So if you missed some of it, go back and listen to the replay. There is a lot of information here about deepwater offshore drilling companies. The most conservative deepwater offshore drilling company, Diamond Offshore, basically said they've taken out their 2 credit cards and they're going to max, which are revolving credit facilities for corporations, and they're going to max them out. So they're going to go into as much debt as possible, maxing out their credit cards, hoping that the oil prices will turn around and that they don't go bankrupt before then. So deepwater offshore, big trouble. Seadrill, I talked about Seadrill on my Patreon account audio podcast a couple weeks ago for oil. I said Seadrill will almost definitely go bankrupt a second time in only a couple years. Again, Seadrill, another example with a dividend payout ratio red flag. And Seadrill would have been an ideal short years ago. When I was an investment analyst, my day job as an oil analyst working with Robert Rapier, and I was just a junior analyst there when I first started. I got a couple promotions after a couple months because they liked my work. But when I first started there, the orders came down from my bosses to write positive research stuff on Seadrill. And I was looking through the company back then. This was like 2013. And Seadrill had, and this was shocking, Seadrill had a 400% dividend payout ratio. Okay, their balance sheet was drastically over-leveraged. This was an enormous red flag. I said if oil prices fall enough, Seadrill, not only are they going to cut the dividend, Seadrill is going to go bankrupt. Their leverage ratios, debt to cash flow, debt to equity, were horrible. Absolutely horrible. It was predictable. Seadrill had a 400% dividend payout ratio. Insane. They were using debt to pay out their dividend. It was nuts. And yet the firm I work for, the paid investment newsletter firm I work for, my bosses told me to spin it and write a positive research thing on it. It was ridiculous. If I was a professional hedge fund manager managing a massive amount of investor capital, that would have been one of the first couple stocks I shorted with a dividend payout ratio that high. It was basically guaranteed that they were going to have to cut their dividend, barring a rapid rise in the oil price. That the management team had over-leveraged the balance sheet so much, it was unsustainable. So, watch the dividend payout ratio. If you're going to stick a toe into oil stocks with dividends, be very, very careful. Go and look at the dividend payout ratio. You might have to monitor this daily with dividend payout ratio if you're going to stick a toe in oil stocks right now. Very dangerous times. I'm not catching a fallen knife. Let's just put it that way. Eric, thank you for the super chat. He's worried about his CalPERS pension. Any chance I do a show on that? They say they have 380 billion. Eric, Real Vision TV has been releasing fantastic content for free about the California pension plan. So they just released one of the pay videos that was behind the paywall for free in the last couple days. Take a look on the Real Vision Finance YouTube channel. They also have quite a few interviews behind the paywall on the California pension plan problem. But I've covered the pension fund problems at length with other pension funds. The problem with the pension funds, Eric, is they don't have to do financial disclosures like publicly traded companies. Chris Martenson interviewed a pension fund activist lawyer who sues pension funds for transparency when he has to sue these pension funds of states and cities and municipalities so they will admit that they were raped and pillaged by Wall Street and hedge funds and private equity on fees. Okay, everyone, I want to wrap this up before my voice goes. I want to thank everyone for listening. I really try. If you're new to my channel, if George Gammon sent you over, definitely hit the like button. Definitely subscribe. There is a lot of good content, research, information, analysis, and financial education here for free on my channel. Also for $5 a month if you want to help chip in. So when YouTube demonetizes my videos now, and I've had a lot of videos demonetized in the last 3 weeks when I did not even mention the cerveza problem, the real word for the cerveza problem, even once. So it wasn't in the title on any of the articles that I have there on a screenshot. I didn't mention it talking for 20, 30, 40 minutes. Didn't even mention it once. Video was still demonetized. So I have to move more of my income to pay my bills over to my Patreon. I don't have a choice. Otherwise, I can't put out the content like this. Then I have to figure out something else. I'll probably just move more content behind a paywall, either on Patreon or on my website or something. Okay, everyone, have a great week. It's going to be, by looking at the markets opening up with the futures and stuff, it's going to be brutal. Because I think more people, to wrap this up here now, more people on Wall Street are figuring out that China has not recovered. Okay? The article that was shared from Caixin Global, if you have not seen, it's a short article. If you have not seen the article from Caixin Global, they cite multiple sources inside China, whistleblowers, government bureaucrats admitting that there is no real recovery inside China. That China is still dealing with rapid outbreaks. And I think that's what has most people spooked. So you have a lot of people going into U.S. Treasuries, but the top bond investor, one of them, Jeff Gundlach, just did an interview for CNBC saying he thinks cash is better. So I think Jeff Gundlach is in cash, dollars, and gold, even though the dollar index has been falling. And if you're new to my channel, I've said in the last week, I've done shows why the dollar index is falling. I think the currency swap lines, where the Federal Reserve Bank is flooding the global economy with dollars, even though we don't have exact proof that those currency swap lines have opened, I think there's a lot of anecdotal evidence that in the last 10 days, the currency swap lines at the Federal Reserve have reopened big, gushing, massive fire hoses of them to the European Central Bank and others. Because the global supply chain is a complete and total disaster. I do not see it being fixed anytime soon.